The Fed reiterating that inflation remains elevated, but again, sharply raising their projections for the Fed funds rate for this year from 3.4 to 4.4%. What does that tell you about how the Fed sees inflation leveling off? If it will level off in the early months.
I think they just want to sound hawkish. I mean, I'm trying to figure out what I'm supposed to be so scared about here. If you look at their projections, they think that inflation will come steadily down. Now, it might take a little while to get to 2%, but honestly, has anybody's life changed between 2 and 3%? I get it that 9% inflation is absolutely intolerable, but those days, I think, are already behind us. And meanwhile, what I think is really interesting in this is if you look at the dot plot, they've built in 75. This meeting, 75 in November, 50 in December, probably 25 early next year. So they're getting up to 4 to 4.25% of the funds rate. And I just don't think the economy can take it. I mean, the dollar is up 20% year over year. Think about what that's doing to our exporters. The whole swath of potential home buyers have been knocked out of the market by 6% mortgage rates. You've got fiscal drag going on. I mean, this economy is really, it's got one foot in the grave and another on a banana skin here. I mean, it really looks like it could get pushed into recession. And I just don't see the reason why. If inflation's coming down slowly, let it come down slowly.
So that's very interesting, and that metaphor is certainly a frightening one. Certainly what Bob said, Ms. Nixon, is that the market is reacting to the idea that rates are going to stay higher for longer. Are you as worried as David is about what sounds like a rather more serious recession in the U.S.?
Well, I guess I would echo one of the comments from a prior guest, which said that the recession may be milder than past recessions because we have more buffers built in. There's more resilience, and we've talked on and on about corporate balance sheets, household balance sheets. So I'm not as nervous about a deep recession, but I do think that this latest dot plot and the summary of economic projections points to a Fed going a lot further than perhaps they need to go, given the inflation outlook, and that they are doing so at a time when the economy is quite vulnerable to a slowdown. It's not just the U.S. economy, it's the global economy. And this may be just a bit of a bridge too far.
Jim, what type of clarity do you hope to hear from Chair Jerome Powell in the press conference? Do you expect him to maintain a hawkish disposition similar to what we saw at Jackson Hole?
So the things that I'm listening to from Powell is going to be how he links the labor market to the current Fed policy. So right now, what the Fed is saying is that they can control inflation without doing too much damage to the labor market. And that is something that really the markets don't fully believe. And in order to really control inflation, it's more than likely that the unemployment rate has to go up more than what the Fed is actually saying. What shouldn't be lost on anybody is that this is a significant marking to market of Fed policy from the June summary of economic projections to the September one today that we just got. 100 basis points higher in marking to market in policy rates for 2022 and almost 100 basis points higher for 2023. This is going to wreak havoc on assets just from a discount rate perspective in terms of how we look at future cash flows and how we need to start to think about valuations. So the faster the Fed goes, and this is what I'd like to hear from Powell as well, this aggressive move may be good in the short term in terms of that it might fight inflation. But what about the recession risks? The recession risks do start to increase dramatically when you see a significant move higher in Fed policy forecasts. And I think that's something that we have to reconcile.